All right. It looks like the market is rebounding a little bit from yesterday. The bulls have stepped in a little bit, especially today. Still a far cry from this 4,500, but maybe we'll work on it next week. This is not what I'm going to talk about, though. I had a client call me the other day and ask if it's a good time to buy crypto. And I told him what I have told him for the past few years now. In my opinion, it's never a good time to buy crypto. Now, let me explain that a little bit. Some of you may say, "Oh, you're just a curmudgeon. Just get with it. Bitcoin's the new whatever. Ethereum's the new whatever." Okay, fine. Um, but nothing can explain this chart other than just value being stolen. People, this is probably everybody's stimulus payment. It went from 600 to 5,000 and then right back down. Same with Bitcoin here. It's rebounded a little bit, but the problem with Bitcoin and the problem with Ethereum and all other cryptos is they're retail based. These are all retail investors. Now, if you're in the business, if you're in this industry, we have a lot of sayings about the retail investor. One of them is if a retail investor calls you with the opportunity, calls you and asks about an opportunity, the opportunity is already gone. You should sell, and you should probably sell to them. Now that's just one of the. It's a shorter saying, but I can't, get into it. But retail investors are a nightmare, and one is they're highly emotional, and they always follow the crowd. They always follow the crowd. Um, you can look at these numbers right here, but I mean, okay. So retail investors, they always follow the crowd. They're highly emotional, and if you're a retail investor, there's no. If you sell to retail investors only, there's no buying base because they all could be buying at the same time and they all could be selling at the same time. Now, let me show you what that means. So here's ContraFund. This is one of the oldest funds. I think it was founded in 1990. For the past, if you had a 401k in the past 20, 30 years, ContraFund was probably in it. Very stable fund, 110 billion in assets. If you look down here, they're gonna have no crypto in it, and I'm gonna get to that in a second. But they're gonna have all the usual suspects: Meta, Berkshire Hathaway, Microsoft, Amazon, Apple, Nvidia, all the usual suspects. This is just a professionally managed buy and hold strategy. They do have cash here, which is about 3% of their portfolio. You could see the different sectors here: technology, consumer cyclical, communication services. Now, this is in a lot of people's 401ks, like I said, a lot of inflows of it, a little bit of outflows, a lot of inflows because people set these up on drip programs, automatic investment programs. Lots of money coming in all the time. Now, this 3 million is probably, most of it is for surrenders, people pulling their money out or taking a little bit on the side for retirement or whatever the case may be. But this is where the inflows go. It probably has pretty consistent inflows from different areas, pension funds, stuff like that. And they go back into these percentages. So let's say for Meta here, let's say Meta skyrockets and they have to sell a little bit to get back under 12. And then they have to buy a little bit of Berkshire Hathaway to get it closer to 9. Now that happens within these funds. But this money here also goes into these to maintain these portfolio weightings and these sector allocations. So if they get money, a lot of inflows here, they're not just going to go in and buy, put it all in Google. They're going to spread it around and keep these percentages relatively stable. They're not going to let any one of them go up or any one of them go down in a big way. That creates a buying base. Every one of these big names has a buying base. Now, that means it will eventually go up because they're constantly buying. A little bit of selling here, a little bit of selling there, but they're constantly buying. Now, see this 13 billion right here and this 10 billion and this 7 billion. They're not going to let these investments go to waste. They're not. They're on each other's boards of directors. They're, friends with each other. They're investors in each other. They make deals together. They broker deals together. These mutual funds just aren't like you and me and just sitting at home buying. They're making deals happen. They're making their investments grow. They're helping out Microsoft. They're helping out Apple. They're looking for deals for NVIDIA. These people are in bed with each other. Now, you can be a conspiracy theorist and be like, what is it, RFK, and say, they're trying to rule the world or whatever. That's his take, but it's just good business. You want your business partners that you have a $13 billion investment in to go up. And they can't invest in Bitcoin. They just can't. It's forbidden. It's illegal. They can't do it. Now there are some ETFs that claim they're crypto ETFs, crypto mutual funds, but they're not. They're crypto based. Now what does that mean? Crypto based means this is ARK W. This is the next generation internet ETF from Kathy Woods. Let's look at her holdings. Here's Grayscale Bitcoin Trust. This is follows the price of Bitcoin. It does not own any Bitcoin. Here's like Coinbase. This is Bitcoin or crypto adjacent, which means that they're a platform for crypto. Block Inc., same thing. Robinhood, same thing. These are crypto adjacent. When crypto goes up, these companies go up. That's a way to get close to crypto without being in crypto. Same thing with ARK F here. This is next generation. ARK W. No, this one's ARK F. Sorry, they're both ARK W. Sorry, ARK F. Let's look at ARK F. ARK F is a little bit closer. That's a fintech innovation ETF. This one has crypto miners in it, which means as crypto goes up, then obviously what the miners are selling goes up. This has crypto miners in it. Also has Robinhood and Coinbase and Block, just like the other one. These are crypto adjacent. They can't actually invest in crypto. So what has to happen for me to invest in crypto? One, it has to not just be retail. It has professionals with the big trillions of dollars in assets under management have to be in the game. They have to be in the game for crypto to work. Okay. Two, it has to have some government sign on. It has to. The SEC has to approve some of it. The SEC has to work with it. And that's probably not going to happen because there's nothing there. They can't leverage it for their advantage. Now, there are some rumors out there that said the government, the U.S. government may issue their own crypto. Now, that's interesting because they're not going to let it fail. They're not going to let it fail. It's not going to have the autonomy and the independence and the no nonsense that Bitcoin has from their blockchain. They will be able to manipulate it, which it kind of defeats the purpose of crypto. So, crypto, in my opinion, is going to become like credit cards. So we use credit cards now. Discover. I like Discover. I like American Express. I like whatever. That's gonna be what crypto is gonna be. I like Bitcoin over Ethereum, or I like Dogecoin, or I like whatever this other coin. I think that's what it's going to turn into. It's just going to be this ancillary paying system where we can pay using that instead of cash. And that's all I see it being. So unless those two criteria happen, then crypto is probably going to be a dead investment for most of us. Now you can have fun with it. You can, see where it goes. You can, it's more like a gamble, buying baseball cards, something like that. But it's never should be a cornerstone of anybody's portfolio. And that's just my opinion.